Caroline Bell from Summerhill Financial Services, just with a bit of an update, particularly in relation to the budget this month. I guess you could really sum up this budget as sort of saying if you're earning over 180,000, you're effectively paying more to repair our budget deficit, and if you earn under $150,000, you're essentially receiving less, and that's your contribution to repair our deficit. So what have we got? So what I've sort of put together is, you'll probably sort of see some bullet points below this video in the email. And essentially I've just tried to categorize them in relation to questions. And if those questions apply to you, then a little bit of a summary of how the budget may impact you. If none of the questions then apply to you, then there really hasn't been too much in the budget that applies to you for this year. Some of the things to really highlight that I just wanted to make clear. The first one is just in relation to the age pension age, and this always causes a little bit of confusion. So the age pension age is increasing to age 70, which really only applies to people that were born after January 1966. So it's applying from 2035 and progressively applying from people that were born after July 1952. So if you were born before 1 July 52, it doesn't apply. But I just want to stress this only applies to the government age pension. If you are never going to claim the government age pension, this has no bearing on you. It doesn't impact the superannuation preservation rules, so it doesn't impact what age you can actually access your superannuation fund. That's not to say that that may not change down the track, but at this stage it hasn't been impacted. The other one is the Temporary Budget Repair Levy, or the TRBL. Essentially what it means is we're back to the top tax rate of 47% for those that can remember when our tax rates used to be a little bit higher. However, we've got another little kick just with an extra 0.5% Medicare levy from 2% So a total increase for anyone over $180,000 of 2.5%. Just wanted to make sure that people understand that this extra 2% only applies on the portion of your taxable income, so what goes in your income tax return, over 180,000. So if your taxable income is 200,000, you're only paying the extra 2% on $20,000, the difference between 200,000 and 180,000. In the blurb below, if that does apply to you, I've put together a couple of suggestions that you may want to think about before 30th of June, just to try and reduce that levy that's going to be applied. The other thing, which is great news as well, is just in relation to excess superannuation contributions. Now, from 1 July 2013, so for the current financial year, if you go over your both your concessional and non-concessional superannuation contribution limit, you can actually elect to have those contributions taken out and just pay tax at your marginal rate, which is a much more concessional practice than what's happening now. As always, if you have any particular queries with the budget and how it may impact you, please contact me and we can work through it. But also, just a reminder, none of this is legislated. These are all proposals at this stage, and they may change between now and when they finally go through. Thanks very much. Speak to you soon.